What a year it has been for the markets. We watched a sharp crash between February and May of 2025, followed by an almost unbelievable rebound where the S&P 500 and NASDAQ pushed to fresh all-time highs by late June. If that kind of volatility gives you financial whiplash, you're not alone. Most people share the same uneasy thought. What if I invest right before the next crash? And that single fear stops countless people from ever building wealth. It leads to paralysis, hesitation, and sometimes even panic selling, the most damaging move any investor can make. But professional investors don't rely on luck. They manage risk deliberately. They use proven strategies designed to keep portfolios stable even when the markets feel chaotic. That's what this video is about. I'm going to walk you through smart, practical ways, ranging from beginner-friendly tips to pro-level techniques, to lower your investment risk and build a portfolio that can ride through turbulence with confidence. Let's start with the foundation: real diversification. And by that, I don't mean simply owning a dozen different tech stocks. Real diversification means spreading your money across different asset classes, industries, and regions. A resilient portfolio includes stocks, bonds, and cash, but also assets that behave differently from the U.S. stock market, such as real estate, commodities like gold, or international equities. The goal is simple. When one part of your portfolio struggles, another part can help stabilize your overall return. Markets shift over time, so diversification isn't something you set once and forget. It requires occasional rebalancing to keep your investments aligned with your goals. Once you're diversified, the next strategy is one of the most underrated tools available to everyday investors: dollar cost averaging. This is the habit of investing the same amount of money on a regular schedule every month, every paycheck, no matter what the market is doing. When prices are high, you buy fewer shares. When prices drop, you naturally buy more. Over time, you end up smoothing out your purchase price and reducing the risk of investing a large lump sum at exactly the wrong moment. Dollar cost averaging isn't about timing the market. It's about using consistency and discipline to make volatility work in your favor. It's one of the simplest ways to keep emotion out of your decisions and stay invested long enough to let compounding do its job. Before we move on, if you're finding these strategies helpful, I've created a free guide that helps you stress test your own portfolio using the same principles. You'll find the link in the description. Use it as a roadmap for your next steps. Now, let's discuss something more advanced: aligning your asset allocation with your personal timeline. Every dollar you invest has a purpose and a timeline. Money you will need within the next 1, 2, 3 years, such as savings for a home or a major life event, should not sit in volatile assets. It belongs in safer places like cash or short-term bonds, because the priority is protecting your principal. On the other hand, money earmarked for retirement in 20 or 30 years can afford to ride the ups and downs of the stock market. This is where a higher stock allocation makes sense, because you have decades for the market to recover from downturns. One of the biggest mistakes beginners make is using a single investment approach for every goal. The pros adjust their risk to match their timeline, and you should too. Finally, let's look at a true professional technique: hedging. Think of this as insurance for your portfolio. One of the most straightforward hedging tools is a put option, which gives you the right to sell an investment at a specific price. If the market drops sharply, the value of your put option can rise, offsetting some of your losses. You're not betting on a crash, just like buying car insurance doesn't mean you want to crash your car. This strategy simply gives you peace of mind. Allocating even a small portion of your portfolio to hedging can add a valuable safety net during periods of extreme volatility. Lowering your investment risk doesn't mean hiding in cash or avoiding the market altogether. It means having a plan that allows you to participate in market growth without constantly worrying about the next downturn. By diversifying, automating your investments with dollar cost averaging, tailoring your asset mix to your timeline, and even incorporating advanced safeguards like hedging, you're building a portfolio that can withstand pressure. Investing shouldn't keep you awake at night. Your goal is to stay invested long enough to benefit from compounding, And these strategies help make that possible. Use them well, and you give yourself the best chance to grow your wealth steadily, sustainably, and confidently. If you found this valuable and you're ready to keep learning how to take control of your finances, make sure to subscribe and hit the notification bell. See you in the next video.